Okay, this is a video of how to calculate depreciation expense using our three different methods: straight line, declining balance, and unit of activities. I've already kind of started setting it up to save a little bit of time, but with our straight line calculation, we're going to take our cost of $96,000, subtract the salvage value, which gives us $84,000 as our depreciable base. We will divide that by our 8 years to come up with $10,500 of depreciation expense each year. So you can see that's exact same. So from year 1 to year 8, we're taking $10,500 of depreciation. Then what is building here, though, is our accumulated depreciation. So each year that balance increases by the $10,500 that we expense. So then when we get to our last year, year 8, we should have accumulated depreciation for the entire $84,000, which was our depreciable base up here. And then when we take our book value, and our book value, again, let me go back to the top, the book value is the $96,000 minus the accumulated depreciation gives us our book value. $96,000 minus the accumulated depreciation gives us that book value. So then if we come down to the very last line, $96,000 minus that accumulated depreciation leaves us with $12,000, which is our salvage value. So that's how you know you've done it correctly if you get to the end of your depreciation table and your book value is equal to your salvage value. Now then I have a little side entry here that says, okay, now what if we then sell that asset? So in year 9, after it's all fully depreciated, we sell it. So then we're going to have proceeds of $15,000 less our $12,000 book value. So that provides us with a $3,000 gain on sale. So that's how we calculate that gain. Then if I asked you to do the journal entries, you're going to come in, whoops, let me come back to it. You're going to come in and say, okay, we received the cash. Somebody is paying us $15,000. So that cash is coming in. Now, this is the part that gets a little confusing. We have to take it off of our books. So this accumulated depreciation now is a credit balance. To take it off of the books, I have to debit it for the full $84,000. Then my credits are going to be we're going to say this is equipment. Doesn't really tell us, but so we're going to assume it's equipment. And the equipment, again, is going to be valued at the total cost of $96,000. So now I'm selling it. I'm taking it off of my books. I have to credit equipment. And then you can look at this entry and say, okay, well, it doesn't balance right now. I have, 101,000? No, what do I have? Sorry, $99,000. I have $99,000 here of debits, and then I only have $96,000 of credits. So then my gain is going to make this entry balance. So then that would be my journal entry for that. If I wanted to come back up here and say, okay, well, what's my journal entry when I record the depreciation? I'll slide that up above here. We're going to debit depreciation expense. Whoops. Try to make it a little smaller. Okay. So then we're going to debit depreciation expense for the $10,500. And then we're going to credit accumulated depreciation. And then again, it would be like dash equipment if we're really looking at it on the balance sheet. So that would be our entry, and we would make that every single year. So each year we would do that exact same depreciation entry right there. And then again until we sold it, and if we sold it, again, depends on what we sell it for, if we have a gain or a loss. So that's kind of the first little scenario mapped out. The other ones I won't quite do to that detail, but the declining balance, again, I already mapped it out to save time. Basically, the declining balance is twice what your straight line is. So if my straight line is 5 years, if my straight line depreciation is 5 years, that would be 20%. And how I calculate that is take 1 year divided by 5. So that's where I get that 20%. So then you take each balance. So I start with 85,000 times 40%, and then that gives me the $34,000. So that's going to be my depreciation expense. That's going to go into accumulated depreciation. I subtract that from my 85,000. My book value goes down to 51,000. That's what starts my next line. So my book value of 51,000 times the 40% gives me $20,400 of depreciation expense, increases my accumulated depreciation to 54,400, and then reduces my book value down to 30,600. Carry that down to the third line, multiply that by 40%, gives me $12,240 of depreciation expense. My accumulated depreciation goes up to 66,640. My net book value goes down to 18,360. Then that will be the number we use to calculate our depreciation expense for that fourth year. So that times 40% gives us 7,344. Add that to our accumulated depreciation balance. Subtract that from our book value. Now then when you get to this bottom line, so this is the most important one to focus on when you're in here. Let's see if I can highlight that. So this is the one that you want to focus on. I guess I'm not, my highlighter doesn't go super straight. That's what I'm trying to do with my arrow. But so focus down here on that line. And I started with this. I said, okay, I want to have $10,000 in my book value at the end of all of my depreciation because I want it to equal my salvage value. So this I know. So I start here and then I work my way back. Well, if I want my book value to be 10,000, my accumulated depreciation would have to be 75,000. So then if I want my accumulated depreciation to be 75,000, if it's currently 73,984, if I subtract that from my 75,000, this gives me how much I need to depreciate in that final fifth year. So it's going to be $1,016 is going to be what I would need to depreciate in order to get my accumulated depreciation to 75,000 and then get my net book value to 10. And again, if we were doing our journal entries, it's the same setup as this. It's just going to be different amounts every year, but we're still going to debit depreciation expense and credit accumulated depreciation. Now our units of activity, I have to fill in the hours per year. So I just started with the first year. So we said, okay, this is our $66,000 piece of equipment. There's a $6,000 salvage value. So our depreciable base is $60,000. If it's a piece of equipment and we think there's going to be 250,000 hours that we can utilize this machine, if I divide those, I get 24 cents per hour. So then how they're going to take depreciation using this unit of activity is you look at how many hours did we run that machine for that year. So in year one, it's 50,000 hours times 24 cents gives us $12,000 of depreciation, $12,000 of accumulated depreciation, and then our book value is going to go from 66,000 down to 44,000. Okay, then in year two, say then it goes up to 60,000 machine hours. So then 60,000 gives us $14,400 of depreciation. So then now my accumulated depreciation is $26,400. And then my net book value goes down. Let me grab my calculator here. 44,000 minus the 14,400. The net book value is going to go down to 29,600. Then in year three, Let's say again, it's a record-breaking year. They have 70,000 hours times the 24 cents. So then that brings us up to $16,800 in depreciation. Our accumulated depreciation goes up to 43,200. And then our net book value goes down to 12,800. Then, whoops, I'm sorry, that was year 3. Okay, but then now it goes down. So now in year 4, so then maybe the year 4 we go down to 25,000 hours times the 24 cents. And that's $6,000 of depreciation. And then that takes it up to 49,200 in our accumulated depreciation. And then takes it down to 6,800 as our book value. But then what we have to pay attention to is how many hours we have. So there I'm up to 205,000 hours. So that leaves 45,000 hours left. Doesn't calculate something's up with my net book values here. Let me go back and double check my totals. So 66,000 minus 12,000. Oh, that's where I'm off. Okay, so sorry, this should have started at 54,000. Minus 14,400. That should be 39. I was off 10,000 with that first one. Minus 16,800 gives us 22. Whoops. And then finally, then this one is 16. Okay, so that seems more like it. Okay, so then again, I'm at the end of the life of the asset is when it kind of peters out and there's not much left. So those final 2 years, they're going to have 25 another year and then 20 the following year. So year 5 is going to be another 25,000 hours. Another $6,000. And that takes it up to 54,200. Whoops, 55,200. And then my net book value then goes down to 10,800. And then my final year has the remaining hours, which would be 20,000. And that's 4,800 in depreciation. $60,000 now is our accumulated depreciation, and then our final net book value is what we would want it to be. Now then the thing is that in real life, obviously you may not get exactly those 250,000 hours, and then either you'd have to probably adjust the rate somewhere as we go, but let's not get into that, make it more complicated than it is. Just take whatever hours they give you, which should add up to what their estimate is, and then it calculates the depreciation based on how that piece of equipment is used. So then that covers our 3 methods and then shows you kind of how it's recorded, as well as if it was sold, how that happens and how that gets recorded into our general ledger.